Hello and welcome to Fundamentals of Macroeconomics. This chapter we are discussing investment, the future of production. First, we need to ask, what is the investment we're talking about in the economy? This is resources dedicated to future production. You build something today to help you build something else tomorrow. Things that will increase the productive capacity in the future. We're not discussing financial assets like stocks or bonds or other pieces of paper. These things simply delineate ownership. And while changing ownerships in the stock market is interesting in the macroeconomy, that's a totally distinct activity from, say, building a new factory, building new machinery and equipment, writing brand new software, or constructing a home. We invest in physical capital, and that helps our productivity. More tools makes labor more productive. Investment is the key to long-run economic growth. This is a big deal. Going back since 1890, on the horizontal axis, we have labor productivity, and on the vertical axis, we have capital intensity. As a country has more capital, their labor is able to produce more and more stuff. And as we can see, it's a pretty tight correlation across time and across countries. If we just zoom into 2015, we see countries lower on the vertical axis. Those with less capital, less investment, are also further left on the horizontal axis. Their workers do not produce as much stuff, creating conditions where countries have more investment in machines, buildings, software, and other forms of capital, create the conditions for long-run economic prosperity. Things are going to get a little dry later on when we start talking about interest rates and savings and business investment decisions, but no, it's all going to pay off to understand why some countries are economically prosperous while others are not. It's one of the underappreciated causes. But we're not done. Fluctuations in annual capital investment is one of the leading causes of business cycles, recessions, expansions, etc. What matters in the short run? GDP is composed of consumption, investment, government expenditures, and net exports. The I is the most volatile of the four components. Investment averages 17.3% of GDP. The particular graph underneath us shows the share of GDP that comes from investment, and we find that investment is cyclical. Each one of those gray bars represents a recession, and we see that inflation drops dramatically during recessions, and then likewise rises afterwards. Most dramatically after the Great Financial Crisis, the housing bubble burst and everyone stopped building houses. Investment dropped to 13% of GDP by 2010. So in this ratio, even though GDP is falling, investment is falling by even more. So investment is a flow. It's how much we spend building new stuff every year. As we invest, we build more capital stock. The capital stock is the total amount of stuff we have accumulated over time. You build a building like this, and it's going to last for generations. All the total building machines, animal herds, software, etc. Just because you build it doesn't mean it lasts forever. Over time, the capital stock depreciates. Houses need repair, machines need new parts, software becomes obsolete. The software one is interesting because the code doesn't deteriorate over time. The code will work forever in theory, but the issue is that the total environment that software is written in changes all the time. And previous code, while working just fine in a previous system, no longer works well in a new system. If you fire up a Super Nintendo system from 1993 and play Mortal Kombat, it's going to work just fine 40 years later, as long as the physical hardware of the machine is still working well. The software hasn't deteriorated 1 ounce. But interesting, the depreciation rate of software, because of obsolescence, is actually much quicker. Buildings, as we imagine, has the slowest depreciation rate. Equipment and machines is next. And the quickest level of depreciation, or quickest level of obsoletism, is that the word? Obsoletism? Obsolescence, is software. We're going to break different types of investment into a few parts. First is business investment. This is business spending on new capital, big machines or buildings. A smaller component, but still very important for understanding macroeconomic fluctuations, are inventories. This is the accumulated raw materials, work in progress, and unsold goods. So you build a car, but it doesn't sell this year. It's not a final good or service, so it won't calculate in consumption in GDP. But you did build it this year, so we will include it as a positive change in inventories. Next year, when you sell the car, it will count as a consumption, but it will also be a negative decline in inventories. We only count it once. It's only that added value of the final goods sold, which will count in GDP in the next year. Inventories are building a thing in order for it to get finally sold eventually. It could be a leading indicator of whether or not we're in a recession. For example, if your inventories build up, you're not going to order as much new stuff in the next year, perhaps causing a recession. Likewise, if your inventories are being drawn down, in the next period, you're more likely to order new stuff, thus helping us to forecast an increase in GDP. Finally, not all investment is done by businesses. Some of it's done by households. When we build housing and apartments for people to live in, we call this residential investment. You don't build that house and consume it in a year. You build that house and consume rental services from it for the next 30, 50, 50, 100 years. And here's all the little components. The largest share of investment in a given year is intellectual property. The 2020s are a different decade. We now write more software and create more digital capital than any other period in history, and its share continues to grow. 1.48 trillion a year compared to the 1.39 trillion invested in equipment. Residential investments a little over $1 billion a year, and business structures are $830 billion. That little tiny blue bit are the changes in inventories, a positive $18 billion that year. Sometimes this number is negative, sometimes it's positive, but it is a very small component. But I want to talk a little bit more about that software. I think it's pretty interesting. Number one, the environment. When we are concerned about long-run sustainability, we recognize that we live in a finite planet with finite resources. We can only build so much new material stuff because there's only so much material crust on the planet, only so much land that we can use. But software, as long as the energy is sustainably created, takes up very little material resources. And if this is the area of capital stock that continues to grow, most of the economy will become digital, even more so than now. Perhaps this is what Mark Zuckerberg is trying to bet on with his company Meta. Over the past decade, a lot of our social interactions are now completely on a digital platform. Over the past 20 years, most of our news and media content come in a digital format. How much of the economy in the future do you think will be strictly digital and not require physical equipment or structures?